Hi everyone, welcome to this topic explainer video for the financial reporting exam of ACCA. I am Aleena Kareem, your expert tutor for FR and SBR exams. Today in this particular video, we are going to discuss a very important area of your syllabus, which is the investment in associates. Now, students tend to focus a lot on the subsidiary related adjustments, but please do not forget that associates are also as important from your exam point of view, whether you are talking about generic adjustment or any special adjustments like intragroup adjustments. So we are going to have a look at how investments in associates are shown in the financial statements, be it statement of profit or loss or statement of financial position, how the transactions between the investor and the investee affect our accounting treatments, and how that can possibly be tested in our exam also. So in this particular video, I won't be following a particular question debrief. This is for the overview of the topic so that you can take it up later on. You have a lot of material from ACCA like Study Hub, you have Practice Platform, so you can access the topic from there also. But I will try to cover all the possible aspects of associate that can be tested in your exam. I'll try to cover them all today in this particular video. So let's start with it. So investments in associates. Now, the first thing is, what is the difference between the subsidiary company and the associate company? So there's a particular standard IS 28 which deals with the accounting for associates. It deals with the accounting for associates in joint ventures, but right now, because we're just focused on associates, so we'll stick to that. So it says that an entity over which an investor has a significant influence. So it is a company in which there is an external investor. Now, investor can be anyone. Anyone having like a 5% shareholding can be an investor. Anyone having an 80% shareholding can be an investor. But over here, the criteria has been further clarified by saying that it is an investor who has significant influence over the investee company. So there is one party which has a significant influence over the other party. Just the word significant influence shows that it is in a position of authority. So it does not have a complete control over how the investee is going to work, but it still has a major influence on it. How that is possible, we will see that shortly. So in terms of significant influence, we first have to identify what do we actually mean by significant influence. So the standard says that it is the power to participate in the financial and operating policy decisions of the investee without control or joint control over those policies. So it is where you have the power to participate. Remember, it is not a power to control. It is a power to participate in the financial and operating policy decisions. So the investor is at an important position, which is why that party has a say in the decision making of the investee. Now, IS 28 says that when this relationship exists, so there is an investor and there is whom we call parent company also, and then there is the associate company, then the accounting is going to be done as per a fixed method of accounting, which is called equity method of accounting. And in this equity method of accounting, basically the concept is that initially the investment in associate is recognized at cost, and later on, the share of net assets which is attributable to NCI based on the percentage holding on it, that is added to that investment. It is very different from subsidiary in a way that because control is not obtained. So over here, the companies, there is no line-by-line additions. The working is relatively simple. It's literally like a one-line entry where you have the non-current assets of the parent company when you're dealing with especially the consolidated financial statements, and you bring in one line, and that is the investment in associate company. Now, in terms of financial statements, when we talk about the equity method, when you're talking about the individual financial statements. So for the investor company in their individual company financial statements, the investment is going to be either at cost or they have a choice to use the equity method of accounting. So they can treat it simply like an investment, like a financial instrument, IFRS 9, or they can use equity method of accounting in the individual company's financial statements. However, this choice is not available when we are talking about the consolidated financial statements. So when we are dealing with consolidated financial statements, the equity method of accounting is a compulsory method to use. Okay, so this is the overall working to give you an idea that number one, there needs to be significant influence. When that exists, first box checked. Then you have to follow the equity method of accounting. In that also, you have to identify whether you're dealing with the individual company or you are dealing with consolidated financial statement. And then you need to further bifurcate that which particular financial statement are you dealing with, and you need to do the accounting accordingly. Now, a very important question that comes up into our mind is that when we say significant influence, how would I know if a company has a significant influence on the other company or not? The answer is very simple. The IS 28 is very helpful. So they provided us certain indicators that when they exist, basically then it means that there is significant influence of one party on the other party. We call it parent because you see, just like we covered that when we're dealing with consolidated financial statements, so there is a parent subsidiary relationship already existing. In that case, if we have an associate also, then it is a compulsion that we have to use the equity method of accounting. So over here, we'll use the term parent and associate. So that's how the equation forms. Now, when we say that the parent company has a significant influence over the subsidiary company, how that is determined, because you see the complete accounting is changing. If it's a simple investment, it is dealt with under IFRS 9. If there is control, it is dealt with under IFRS 10, and we're completely going into the consolidation working, IFRS 3 also. However, if there is significant influence, then we have to follow the equity method of accounting. So there are certain indicators. If they are present, then it shows that there is significant influence. All of them do not need to be present. Even the presence of only one can show significant influence. So number one is representation on the board of directors. So let's suppose in a board, there are 8 board of directors and the parent company has that much investment in the associate company that they can nominate one board of director as per their choice. So that is called the representation in the board of directors. Then participating in policy-making process, that's clear from the definition also. Material transactions between the investor and investee. So that is also a very strong influence or a level of control. So there's not complete control, but still there is enough power that the decision-making can be affected. If not completely in your own hands, at least it can be affected. Interchange of managerial personnel, provision of essential technical information. Once again, the whole point is that if something which is very important for your business, that is in the hands of the parent company, then it automatically has a significant influence. From our exam point of view or from a mathematical point of view, we normally say that if there is 20% or more, but less than 50% holding in a company, then it is an associate relationship. So greater than 20, greater than or equal to 20, but less than 50%, voting rights or number of shares, that shows the significant influence. Please do keep this in mind that in your exams, we have seen this in the past also, that the examiner straightforward gives you the criteria and expects from you to identify whether a company is a subsidiary, associate, or a simple investment. So these are the criteria that can help you identify. At times, from a theoretical point of view, the percentage shareholding may be less than 20%. But because of any other arrangement, like exchange of managerial personnel, representation on the board of directors, there still may be an associate relationship. However, from your exam point of view, the mathematical questions, in that the examiner facilitates you by always giving a percentage when concept of associate is tested, it's always greater than 20% and less than 50%. Now, accounting for associates. Important, once again, very, very important date is the date of investment, because that identifies from where onwards you are going to do your accounting. So in case of accounting of associates also, when you're dealing with a question, first of all, the first thing that you need to highlight in your question paper is the date of investment. Once you've identified the date of investment, then anything that is happening on or before the date of investment, that is pre-investment time period, and anything which is happening after the date of investment, that is the post-investment time period. The accounting changes for both periods, so we need to be very clear when the date of investment is. Now, in the pre-investment time period, there is no impact on statement of profit or loss or other comprehensive income. However, at the date of acquisition, the associate is recognized in the statement of financial position at cost. So the initial measurement of associate is at cost. Then, if we talk about the post-investment time period, in case of, once again, the working is much simpler than subsidiary company. There is no line-by-line addition of any income expense. Rather, we have a one-line entry that we make. So investors share in the profit after tax and OCI, depending upon the percentage. That we identify and we add it to the group profit. So it's literally like a one-line entry in which we identify what is the parent company's share in the associate company's profit. We take that out and we put it in the group financial statements. We'll see a detail of this shortly also. And in case of statement of financial position using the equity method of accounting, we have a tab in the non-current assets, which is called investment in associate. In that, all the working related to investment in the associate is shown, one final figure. And there is no line-by-line addition of assets liabilities because there is no control that is existing over here. Now, first of all, let's start off with the accounting for associates, the statement of financial position part. How we are going to show it in the statement of financial position. So this is a summary that I have created for you in which most of the items have been covered. So when a question comes up, you can use this format to solve it as well. So first of all, the investment in associate is shown in the non-current assets. Because it is a long-term investment, if an investment is held with a very short intention or it is already held for sale, then it is not going to be accounted for as an associate. Now, once you have classified it in the non-current assets, the first baseline is always going to be the cost of investment. This is the cost of investment. This is the cost of investment which was identified at the date of acquisition. Then we start giving associate its share. Now, forget the format for some time. Just keep in mind that if we have made investment in a company of, let's suppose, $5,000. Now, this was at the start of the year. Now we are at the end of the year. What can be the possible change in the value? Now, the associate company has earned a profit during the year. And out of that, because we had a 25% shareholding, we want to have a 25% share. So that profit we can take up. But then some part of it would be distributed also as dividends. So we basically pick up the post-acquisition retained earnings and use them in our working over here. So cost of investment, we start off with that. Then we have the investor's share of post-acquisition retained earnings. We'll discuss this, that retained earnings, as you know, profit minus dividends. That figure we take up, and on that we apply the percentage of our holding. So that's going to be the investor's share of post-acquisition retained earnings. At times there is a loss, so you have to attribute the loss also. It's not just the profit. Then impairment of investment from acquisition till date. So if the question tells you that there is an impairment, Please do keep this in mind that in case of associate, there is no calculation of goodwill at the date of acquisition. Whatever goodwill we have paid for, so what is goodwill? When we pay above the regular value of the investment, and that is called goodwill in case, a very simple definition of it. But over here, please see that we are recognizing the investment at cost. So whatever we are paying, be it goodwill, be it simple investment, the fair value of net assets, fair value adjustment, everything is included in this one word, which is cost of investment. So everything is included over there. However, if the question tells you that there has been an impairment of goodwill, then you have to subtract that from the date of acquisition till date, because you see, when we say post-acquisition retained earnings, if the acquisition was done 3 years ago, still you have to start off every year from the date of acquisition, and you need to come down to the current reporting date. This is how the post-acquisition retained earnings are identified. And on that, the percentage of investment is applied, which is why I've used the word investors' share of post-acquisition retained earnings. Then from this, we subtract the impairment of investment from acquisition till date, because when the retained earnings are for 3 years, from the date of acquisition till now, then any other thing, income or expense, that is also going to be from the acquisition till now. So impairment of investment from acquisition till date. And one more thing that can come up as an adjustment is the unrealized profit if it is a downstream transaction. Just remember this for now, the accounting treatment. We are going to discuss the unrealized profit shortly, the upstream, downstream, both transactions. Now, the final figure that we get over here is the investment in associate in statement of financial position at the reporting date. So from the date of acquisition till now, till the reporting date, we are going to identify that. Then, a few important facts that you need to remember about investment in associate. Number one thing, that the post-acquisition retained earnings, how are they calculated? You have to identify the share of post-acquisition profits and subtract from it any dividends that have been received. Because retained earnings are what? Profit minus dividends are retained earnings. And that is what we have to pick up for the working. We are not saying share of post-acquisition profits. We are saying share of post-acquisition retained earnings. Then, the profit or loss adjustments need to be made in consolidated retained earnings also. Anything which on the asset side is impacting investment in associate, be it an increase or a decrease. On the other hand, it would be impacting the consolidated retained earnings, because we have to follow a double entry rule. So any income which is increasing the value of investment in associate is going to be an income in the consolidated retained earnings, and anything which is being subtracted is going to be subtracted from the consolidated retained earnings as well. Once again, no line-by-line addition is done. It's still a very common error. The examiner has repeatedly pointed this out, that the students at times mix this phenomena and they do a line-by-line addition for the associates also. That's not the case. No other working is done. We just have one item in the asset side, and that is the investment in associate. Then there's no separate calculation of goodwill. We just discussed that. There is no cancellation of intra-group receivables or payables. In case of subsidiary company, please remember that we say that if parent company owes money to subsidiary company or subsidiary owes money to the parent company, we cancel off the receivable, we cancel off the payable. No such working in associate. So in case of associate, actually your life is much easier. So you need to leave the balances as they are, because there is no line-by-line addition, so there is no cancellation also. Again, if there is a dividend receivable or a payable, remember, dividend income we adjust, but no dividend receivable or payable is adjusted over here. Why? Because there is no line-by-line addition taking place. Associate is showing its own working, so we keep them both separate. We do not cancel off any assets with the liabilities. And even if there is a long-term loan that is associated with the associate company, that has been given to the associate company by the parent company, that is also going to be a part of the investment in associate rather than showing it separately. Now, something that I said that we'll discuss shortly, very important part, intragroup unrealized profits. So when we are talking about parent and associate company, many a times they are involved with each other in terms of trade also. So one aspect is the shareholding, but the other is the operational side also. Parent sells goods to associate company, associate sells the goods to the parent company. So how do we account for these transactions? Whenever we are accounting for intragroup unrealized profit, there are two things that you need to keep in mind. Number one, it is intragroup unrealized profit. If I take it in the reverse order, number one, it has to be profit. So if one company is selling goods to the other company at a loss, that's not going to be accounted for over here. Number two, it is unrealized. So these are the goods which were sold by one party to the other. The other party tried to sell it to third parties, but something which was sold to third parties, we do not bother about that. The part or the goods that were left unsold at the year end, those are the ones that we identify. Those are the ones on which we calculate the unrealized profit. And it has to come through an intragroup transaction. So in case of intragroup unrealized profit, we need to see who has made the sale to whom. So there are two types of transactions that may take place in terms of intragroup unrealized profit: downstream transactions and upstream transactions. In terms of downstream transaction, it is the parent making the sale to the associate company. In such case, the double entry is going to be passed with the percentage of associate. Remember, in fact, that's easier in case of associates, that in both upstream and downstream transactions, the double entry is passed with the percentage of holding. However, the double entry is different because one party has the inventory and the other party has recognized the profit. It's very easy. Try to remember whoever has earned the profit, the profit is going to be reversed, and whoever is holding the inventory, that part we are going to adjust accordingly. Now over here, in case of upstream transactions, it is the sale by associate company to the parent company. Again, elimination of profit by percentage holding. Now, in case of downstream transaction, because parent has made the sale to the associate company. Now, in that case, associate company, it will have a higher value of inventory, and overall net assets might be higher. So in that case, we credit the investments in associates, and because parent company made the sale, it was recognized in the cost of sales also. So that is something which is going to be debited. So debit of cost of sales and credit to investment in associates. On the other hand, when we talk about the upstream transactions, when the sale is made by the associate company to the parent company, in that case, parent company has the inventory, so we credit the inventories. And on the other hand, we debit the share of profit of associate because associate has recognized that profit and we remove that profit away from its workings. So please keep these double entries in mind. These are very important from your exam point of view. Now moving on to the accounting of associates in case of statement of profit or loss and other comprehensive income. Now, in this case, once again, our life is much easier because the treatment is much simpler as compared to the subsidiary company. Now, starting off with investors' share of the associate company's profit after tax is taken up. No line-by-line addition. We just take up the associate company's profit after tax or loss after tax, and we apply the percentage holding to it, make a couple of adjustments, and then that is something which is going to be shown as a separate line item in the consolidated statements. Now, once that profit has been taken up, then in case of OCI, also a similar approach is followed. The associate company's OCI is taken up. On that, we apply the percentage of holding, and then it is added to the OCI of the group as a separate line item. Then there is no line-by-line addition of any income or expense, sales, anything. No line-by-line addition whatsoever. And then associates' share of profit or loss after tax is calculated after deducting impairment and unrealized profit. Please remember something that we are doing in statement of financial position. automatically that's not going to update the statement of profit or loss. So in both the places, we need to go and independently do the adjustments. So the adjustments that we just discussed with respect to unrealized profit and impairment, we are going to adjust them over here also. If there is any dividend which has been received, so any kind of dividend income, that is going to be removed because we don't want double accounting. On one hand, we are taking the share of profit. If we show the dividend also, that is going to be double accounting. So we remove that from the financial statements. Then profit or loss and OCI is time apportioned if the investment was done during the year. This is pretty straightforward. If the associate was our associate only for 5 months, then we will do the accounting only for 5 months. Because statement of profit or loss is for the year, so we need to identify what investment was standing for what time period. Then no adjustment of intra-group sales and cost of sales is done. Pretty straightforward.
As per IFRS 18, the investment in associate, as per the equity method of accounting, is shown in the statement of profit or loss only to the extent that there is share of profit which is available or there is a gain on disposal related to associates. This is how we place it in the statement of profit or loss. We first have the operating profit. The gross profit comes first, then afterwards in our P&L, operating profit comes in. After that, we add the share of profit and gains on disposal of associates. Now, once that has been done, the figure that we get is the profit before financing and income taxes.
Now, this is all with your associate accounting. As you can see over here, I've made the reference of the syllabus also. Different syllabus areas, please focus on them. In one of the recent updates in the syllabus, the examiner has emphasized that dividend is also something which can be tested over here. The dividend being given by one party, which is the associate company, to the parent company. Also, the intra-group adjustments, they have also a high likelihood to be tested. So all parts are important. As you know, in FR, you can't pick and choose any kind of topics, but just be careful that these recent additions also, they are not really additions, they were there beforehand also, but they have been clarified in more detail now, so they can come up in your exam. Now, at this point, I would like to take you to the study hub and show you a couple of questions from there also.
Let's see in the study hub how investments in associates has been covered. Here we have a specific chapter related to it which talks about what associates are, what is the objective of IAS 28, what is significant influence, accounting parts, equity method of accounting, impairment, transactions with associates, everything has been covered. So you can go through the text from the ACCA study hub also. I will touch upon the trading transactions in which there is at times trading between the group and the associate company, upstream selling or downstream selling, it varies. Now, in case of unrealized profit, the important thing is that how we are going to eliminate the unrealized profit if any such intra-group transaction exists. So, whenever there is the sale of goods from associate to parent, it is called an upstream transaction. And to eliminate it, we debit the share of profit of associate and credit the inventories. And if it is downstream, then cost of sales is debited and investment in associate is credited. There is a very good question with respect to this in the ACCA study hub. You can see it over here that they have given a situation with 40% holding, acquisition was done, there was significant influence, and then during the year there was an intra-group sale. We first calculate the unrealized profit on this intra-group sale. This is just like any other calculation of unrealized profit. Once that has been calculated, then we need to identify that based on our percentage holding, we need to eliminate the unrealized profit. So the total unrealized profit that had come up was 400. Out of that, we take 40%. We debit the cost of sales, credit the investment in associate. Why? Because in this particular case, P company, which is the parent company, had made the sale to the associate company, so it was a downstream transaction. We have other such questions also available for practice if you want to go through them. Over here, it is talking about the dividend, and these dividends, they are not included in the calculation of the consolidated financial statements because we give the share of profit of associate. Here also, we have a very comprehensive question which is dealing with a parent company, subsidiary and an associate company. So please attempt this to get a good idea as to how your statement is going to look once you are doing the working in it. This is what I was mentioning to you, that we have the operating profit. In the operating profit, we add the share of profit of associate. Now, once we have added this and there is any other investment income, then we get the final figure of the profit before financing and income taxes. Now, let's move back to our presentation to continue our topic from there.
So here we were at the discussion of the syllabus. Once you've covered the syllabus, then in case of exam application, associate questions, we have seen them all across the exam. So in case of OTs, OT cases, CRs, very frequently it comes up with the consolidated financial statements, CRs also, and also in the interpretation of financial statements where a company is trying to make a comparison with maybe a consolidated financial statement or considering any such a company which can be taken over, there might be working, in which case the investment in associate needs to be identified. Now, with this, we come to the end of this topic explainer video. My tips that I always give, it is practice, practice, practice. Now you have seen, you've gone through the topic. If there is any part which is not clear, you can go back, pause, listen to it again. And then you can, using the formats and the knowledge that I have shared, you can easily solve the past exam paper questions or any practice material which is available on the practice platform or study hub, you can solve them. So please do written practice of your work, keep yourself time managed, and actively read the solution after attempting the question. If you follow this, you'll be able to easily ace the financial reporting exam. So thank you so much for joining in. I hope you found this session useful and you'll be able to easily handle the investment in associates now. Best of luck for your exam. Thank you.